Today we're going to talk about entrepreneurs and their businesses. In my 9 years of working exclusively with entrepreneurs, there are a few things that I've learned along the way. And one thing is that most of the entrepreneurs treat their business as a key source of income and a key business asset. One of the main reasons for this is in most cases, entrepreneurs are people that really know how to make money very easily using their businesses. They may not be the best people to manage that money, but they are certainly the best people to figure out how to make money using that business. So needless to say, because they are not very good at managing money, but more good at making money from their businesses, in most cases, certain key factors get ignored. And today what I'm going to talk to you about has to do with the risks of running a business that an entrepreneur usually tends to oversee. Along the way, I've had the pleasure of meeting entrepreneurs who understand this completely and have taken some great measures to protect their business and the key people in their organization to ensure that that money-making machine continues to churn out cash on a regular basis, regardless of the situation. The concept we're going to be discussing is called key person insurance or Keyman insurance. One thing that entrepreneurs tend to do really well is recruit the right talent to help them manage the business. This could be recruiting the right level of CFOs, accountants, operations managers, etc., etc. And the risks that are associated with specific businesses may have to do with a breakdown of machinery, may have to do with a certain liability, could be insuring specific tangible assets and intellectual property that could be at risk. And in most cases, the entrepreneur does not hesitate on shelling out that kind of money in premiums to cover the risk of things breaking down, to ensure that their profits and the operations of their business remain constant. However, what I've seen most commonly is that the entrepreneur tends to forget to insure his other key assets, and these key assets could be people. It could be your top sales performer, it could be your director, it could be someone who's responsible for 30, 40, 60 or even 80% of your profit. These people are termed as key people in the organization or a key man in the business. Keyman insurance is really a product or a service that insures the key people in the organization, which means in the event you lose a key person, then the payables from the insurance company should be able to sustain the profits of the company for X number of months or as planned. I'm going to explain to you the consequences of losing a key person within a business. A key person in the business, as I mentioned earlier, could be a director, could be a partner, could be somebody who is liable financially for the success of the business, could be your key salesperson, could be a key operations staff, or even your CFO for that matter. For simplicity, let's take the example of a key salesperson. Typically speaking, in an organization, if you follow Pareto's principle, you have the 80-20 rule, which means 80% of the business is produced by 20% of the people, right? Let's take one of those people for instance. Let's assume that a company brings in a net profit of $10 million a year. And let's assume that the top salesperson in that company is responsible for $4 million out of the $10 million of profit. What are the consequences of the company losing that key salesperson, God forbid, due to death or disability or even a critical illness? How long does the company take, or how long will the company take to groom the next person in line to get to that level? What happens in the interim to the clients that that top salesperson of yours was servicing? What happens now to the profits that that top salesperson was generating on a yearly basis? That's a $4 million hole. That could take you between 3 months, 6 months, a year, 2 years, maybe 5 years to recover from. The ideal scenario over here would be to insure that key person in your organization for either the annual level of profits that he brings in or a multiple even of the annual level of profits, if you think it takes longer to groom that individual or the next person in line to get to that level. In my previous example, it was fairly simple to understand the correlation of a sales performer to the bottom line of the business. What I'm going to talk to you about now is one of my key clients who has been running his business for the last 20 years and decided about 4 or 5 years ago to hire a CFO. And this individual transformed his business completely because using the connects that he had built over the last 2 decades or so, started negotiating with banks very hard in terms of lending rates and took away the focus from the entrepreneur to the business itself, thus reducing the liability tremendously. Now, if this key person, this CFO, were to pass away, it's very possible that the relationships of the banks that are held by him will now come under question. It's very possible that the business will no longer enjoy the same borrowing rates and the same flexibility that he was able to bring to the table. In a situation like this, it's very important to identify what does this individual bring to the bottom line of the business and how can you associate a value in the event he passes on. The advantage of covering him today would ensure that the business continues regardless of a key individual passing away. In a more recent case, we insured an individual within a jewelry firm whose key employee was someone that was responsible for the operations of the business completely, thus freeing up the entrepreneur to run a parallel business that was soon going to become the bigger income generator. In a situation like this, the individual thought it made more sense to not just cover the employee for life cover, but also offered critical illness cover for the same reasons that if this individual were to get sick, then the $750,000 that he brings to the table or is responsible for in terms of profit for the business could come under question because they would need to find a replacement for that period. So he actually went ahead and purchased a life insurance and a critical illness cover for $750,000 to ensure that the key person in the organization is covered. When purchasing a key person insurance, here are some of the key points to remember. The first step would be to identify who are the key people in the organization. These are people who are integral to the business's success. The second step would be to determine the value of the contribution. In other words, if the business was to lose that key person, what is the financial loss that business would suffer and for how long? That financial loss essentially is what the company is looking to cover by purchasing a Keyman policy. The multiple factor over there depends upon you as a business. It depends upon the premium paying capacity and how much of a buffer you'd like to cover for. For instance, if you think it would take you 1 year to recruit and retrain somebody else to fill that block, then you need to consider associating a policy that can potentially cover 1 year of losses. If you think it could take you longer, or you need to have an additional buffer associated with it, then just use that. So the multiple could be decided as a company with your CFO and your advisor based on what the requirements are at the moment. This now gives the business a whole 12 months to plan for recruitment, training, and coaching so that they can bring the next sales advisor up to speed with managing of the accounts and generating the same level of profits. If the business thinks that they needed a year and a half worth of profits to cover this, then they would purchase a life insurance policy for $6 million and not $4 million. What I'm going to speak about next is the structure of this kind of a life insurance policy. Typically speaking, these policies are term insurance policies as they are most cost effective. However, I have come across a few entrepreneurs who prefer to purchase this contract as a universal life or a whole life policy with the mindset that in the event an employee leaves them in the future, because they were such an integral part of the business, they would give them or gift them that life insurance policy for them to manage on their own after they have completed their service with the company, thus doubling up as a pension plan or some kind of a saving structure for the employee as well. Typically, the owner of this policy would be the business. The payer of this policy would also be the business. The life insured of the policy would be the specific key person, and the beneficiary of the policy would also be the business.